Hey guys, welcome back to the channel. In today's video, we'll be discussing cryptocurrency and the accounting implications of having cryptocurrency on a company's balance sheet. And the reason why we're talking about this is this is becoming a hot emerging topic when it comes to accounting and finance in general, with more and more companies adopting cryptocurrency and putting it on the balance sheet. Most recently seeing Tesla putting almost 10% of their cash into Bitcoin on the balance sheet. And also Uber in the recent conference call with their earnings, the CEO talking about Uber accepting Bitcoin for Uber rides. So this is not going away. This is going to become more and more adopted by more companies. And so for us as accountants and financial analysts, we need to be aware of the accounting and the financial implications of having Bitcoin on the balance sheet. So for accountants, you need to be aware of the accounting standards around Bitcoins and cryptocurrency. And if you're a financial analyst, you need to be aware of the strategic impact. What happens on the balance sheet and on the income statement as a result of having a cryptocurrency on the balance sheet, which is what we're gonna go into today. So we'll jump into my computer and we'll go over cryptocurrency. We'll go over the definition, what it is. So if you're not super familiar with what cryptocurrency is, we're gonna go over the definition and how it's created to begin with. And then we'll talk about the accounting impacts or implications of having it on a balance sheet. And then we'll discuss the concerns using Tesla as an example. So we'll go over Tesla's adoption of Bitcoin and what kind of impact it's gonna have on its balance sheet and its income statement. That's the topic of this video today, so stick around. If you're new here, welcome. My name is Bill Hanna. I'm the financial controller. I'm a licensed CPA in the great state of New York, and I have over 15 years of experience in the field of finance, where I started out at PricewaterhouseCoopers as an auditor, and then I transitioned out to private industry, and then I worked my way up from a financial analyst position all the way up to a corporate controller position, which is what I do today. And this channel is all about giving you the summary or the juice of my experience over the last decade and a half. And I do this here in the YouTube channel as well as on my website through blog posts, an online course, and templates. So go ahead and check that out as well. All right, so in order for us to talk about the accounting for cryptocurrency, we need to understand what cryptocurrency is and how it's created. So in understanding what cryptocurrency is, we need to understand there are two types of currencies. One is fiat currency, which is an example is the US dollar, the British pound, or the currency that we use on a day-to-day basis to conduct transactions. And fiat here, when we say fiat, we're not talking about this kind of fiat, right? We're talking about fiat here is a Latin expression or a Latin word that means, I think the meaning is let it be done. And let it be done is in reference to the government decreeing that this is the currency that it's backing, right? So this is a mandate by the government. The government is backing this currency. So it's centralized and backed by the government. And the second type of currency is what's emerging now is cryptocurrency. And as an opposite to fiat currency, cryptocurrency is not backed by the government, so the government won't guarantee its value. If you take a Bitcoin or any kind of cryptocurrency and go to the government and say, I lost my value in this currency, make me whole, that's not going to happen. The government does not back this currency. It's decentralized, and as such, it's also unregulated. The government does not regulate and keep track of it. So for a fiat currency or a US dollar, as an example, the government keeps track of all of the serial numbers of all the currency that exist out there, right? So the government is keeping track of a fiat currency, but cryptocurrency is decentralized in the sense that its ledger or the serial number of all of the currency that exists does not belong to one entity. It's decentralized. So this is the main differences between a fiat currency and a cryptocurrency, which is the kind of currency we're talking about today. An example of it will be Bitcoin, as we'll go into it in a second. And beyond that, it's really crucial for us to understand how cryptocurrency is created. So the cryptocurrency is created in a process referred to as mining, right? In which case the miner, or in this case here is a highly skilled computer programmer, the miner is awarded a transaction or a fee, what we call here a coin, in exchange for contributing to the underlying blockchain algorithm by being the first either to solve a puzzle or maintain or contribute somehow to the ledger that is the underlying ledger for this series of coins. So in this case, you need to be a highly skilled computer programmer to be able to do this mining activity, which involves maintaining and contributing to the ledger, for example, of a Bitcoin. So this is the process of creating a cryptocurrency. It's referred to as mining. This is going to become crucial for us to understand as we talk about the different types of companies or entities that we'll look at the accounting for. So a mining company will account for cryptocurrency different than a company like Tesla, for example. That's why it's important for us to understand how cryptocurrency is created, since it's not backed by government, it's decentralized. So the process of creating it is referred to as mining. All right, so based on all of that, we can ask ourselves the question, what is a cryptocurrency? Well, it's a currency that takes the form of tokens or coins and exists on a distributed and decentralized ledger, which means that this is the opposite of what a US dollar is, for example. So US dollars are maintained in a ledger maintained by the government that includes all of the serial numbers that exist of the US dollar, right? So you can't, as an individual, you can't just go out and create a new banknote with a new serial number. That will be considered forgery, and you'll go to federal prison, right? But with a Bitcoin or a cryptocurrency, the responsibility of maintaining that ledger is distributed and decentralized amongst all of the parties that are involved, which is the miners. We just talked about the miners are the individuals who are creating and contributing to the actual ledger and creating the coins, and the actual parties who buy the Bitcoin or the cryptocurrency, such as Tesla. In this case, when Tesla buys Bitcoin, it becomes a party to the ledger, and so the responsibility of maintaining the ledger and the serial numbers of these cryptocurrency is decentralized, and this is the key difference between a fiat currency such as the US dollar and cryptocurrencies such as Bitcoin. Some really key aspects for us to understand about Bitcoin and cryptocurrency in general is that, number one, it's a digital asset that is intangible. So obviously we know it's an asset. We know it's not tangible because you cannot touch it. So it's an intangible asset, and it's an intangible asset with an indefinite life, right? So it doesn't have an expiration date. So they call it an indefinite life intangible asset. So this is the first thing we got to know. And then the second thing is that it's used as a means of exchange, right? So this is emerging. It's not yet widely acceptable, but more and more you've heard from Uber, like we said, they are talking about accepting Bitcoin for Uber rides. There are some car dealers that we read about online that are selling cars accepting Bitcoin. Tesla is hinting that they'll accept Bitcoin in the future. So it's becoming a means of exchange, which is very similar to fiat currency or US dollar. It's going to become more and more acceptable as a means of exchange. And then the other thing is that it uses a highly sophisticated types of encryption. And what that means for us in terms of accounting is that it's created by highly sophisticated computer programmers. So your average Joe is not going to be able to create a new Bitcoin, right? You need to have highly sophisticated skills in computer programming in order to create a new Bitcoin. The other thing that's super important for us to realize also here is that the Bitcoin or the cryptocurrency is not backed by the government, which means that the government does not guarantee the value of the cryptocurrency, right? Unlike the US dollar, for example, if there's someone that doesn't want to accept the US dollar, you're trying to buy something and somebody says, I'm not accepting your dollar, you can go to the government and say, hey, I need you to legally enforce the value of the dollar. And the government can then legally enforce the value of the dollar because the government guarantees the value of that dollar, right? With Bitcoin or cryptocurrency, it's different. You can't go to the government if the value of the cryptocurrency is lost. You can't go to the government and say, hey, party X doesn't want to accept the cryptocurrency. The government is not going to intervene, right? This is completely away from the government. It's not backed by the government. And in fact, in some countries, trading in cryptocurrency is illegal, right? So you got to know your surrounding, which country you're in before you begin trading in cryptocurrency. Because in some countries, even in a smaller number of countries, it's not only illegal, but you go to jail for it, right? For trading cryptocurrency. So I can imagine in the future, two inmates in a prison talking to each other, the one saying, what are you in for? Is it rape, murder? What are you here for? And he'll just say that I sold a mattress for a Bitcoin, right? So you need to know where you are in the world before you begin trading Bitcoin, because it's illegal in some countries. All right, now let's talk about the accounting for cryptocurrency, which is emerging as a hot topic in accounting. So if you really want to stand out in the future as an accountant or a financial analyst, you want to begin reading up on the different accounting implications, and that's why I'm making this video. I want to raise the awareness. I want to get you to think about cryptocurrency, the treatment on the balance sheet and the income statement, the impact from in terms of KPIs and financial metrics. This is really becoming a hot area. And when we talk about accounting, I'm going to talk about US GAAP because I'm located in the US, and US GAAP stands for obviously generally accepted accounting principles, which is what we eat, sleep, and breathe here as accountants in the US, right? So when we talk about US GAAP, the US GAAP currently does not specifically address the accounting for cryptocurrencies, right? The questions are being raised to the different regulatory bodies when it comes to cryptocurrency, but currently the US GAAP is still kind of in the early stages of addressing the issue. It's kind of behind IFRS. IFRS is the international version of US GAAP, and IFRS already has some standards that address cryptocurrency. So IFRS is ahead of the curve. Surprise, surprise. Just like many other areas, IFRS is ahead of the curve of the US GAAP, right? So currently, US GAAP does not specifically address the accounting for cryptocurrency. The other thing to know here is that cryptocurrencies are not cash or cash equivalent because they are not a legal tender, and they're not backed by the government, right? So in terms of balance sheet treatment, when you are classifying Bitcoin or any kind of cryptocurrency, you can't group it together with cash and cash equivalent, right? It sits entirely in a different section. We'll talk about it here in a minute. But the reason why it doesn't sit as cash or cash equivalent is because it doesn't have the legal power of cash, right? Cash has a legal power that is imputed or backed by the government, right? So cryptocurrency doesn't have this power, right? And as such, it sits either as an intangible asset or as an investment. And we'll talk about the distinction, which company can recognize it as an investment, which company can recognize it as an intangible asset. So these are the important aspects to understand in terms of US GAAP. And now we'll dive into more of the treatment on the balance sheet and the income statement. So first, let's look at the balance sheet and how cryptocurrency will be traded on the balance sheet of a company. So for us to understand this, we need to understand that the type of company. So for example here, Tesla as an industry, the way it's going to recognize the cryptocurrency on the balance sheet is going to be different than if you look at an investment firm like BlackRock, right? So I'm going to show you the differences in how a company like Tesla versus a company like BlackRock will treat the cryptocurrency on the balance sheet and then the income statement. And the other kind of firm we'll discuss is a mining firm. So this is a third type of business that will get to recognize the cryptocurrency on the balance sheet in a different way than, say, Tesla or BlackRock. So a mining firm like Riot Blockchain, as an example here, is going to recognize the item on the balance sheet differently from Tesla and BlackRock. So let's talk about Tesla first and the way Tesla is going to look and book this item on its balance sheet. So the way it's going to sit on the balance sheet is going to sit as an intangible asset, right? And it's going to be recorded at historical costs. So Tesla, in this case, is not going to get the opportunity to record this item here as an investment. So when we look at the next company, which is BlackRock, they get to record this as an investment. And the reason is they are in the business of investing or speculating on the value of different stocks and financial instruments, right? So for Tesla, they would have to record it at historical costs, right? And sit on it at historical cost. And we'll talk about the impact on the income statement in a second here, but the value is going to sit in the balance sheet at a historical cost, and Tesla is not going to get the opportunity to mark it up as the value of Bitcoin goes up, which may seem unfair, but these are the accounting rules, is that Tesla, as a company that's not in the business of investing and speculating on these item of financial instruments, is going to sit as an intangible asset at a historical cost and can only record gain when the Bitcoin is sold, right? Only when it's sold. But you can record an unrealized gain, say if Bitcoin suddenly surges up to 100K in value, Tesla's not going to get the opportunity to record that. And we'll get to that in a minute. We'll talk about the income statement in detail here in a minute. But the main distinction that you need to take away from this is that a company like Tesla will record it as an intangible asset, whereas a company like BlackRock, which is an investment firm, will get to record it at cost, but can take a mark-to-market, or that's what we call fair value accounting, right? It will get to record, increase the value on the balance sheet as the instrument value goes up without selling it, right? So they'll get to record a mark-to-market because they are an investment firm. And then when we look at a third type of company like Riot Blockchain, this is a mining firm. So they are in the business of creating the blockchain, or creating the cryptocurrency. So for a mining firm like Riot Blockchain, they can record the item on the balance sheet in a different location. And I'm going to let you guess where they can record it. So we said Tesla can record it as an intangible asset. BlackRock, as an investment firm, will get to record it as an investment. Where would a company like Riot Blockchain, which is in the business of creating the actual cryptocurrency, if you can guess? I'll give you a second to guess. Okay, so they would record it as an inventory, right? So a mining firm like Riot Blockchain is in the business of creating. So their business model is to create it. So this is similar to like if you're a manufacturer of an actual physical good. When you create an item for sale, it's your inventory. It's the same case here. So Riot Blockchain creates a Bitcoin. It gets to record it as inventory. And obviously as inventory, it's recorded at the lower of cost and net realizable value. So if you want to brush up or refresh your memory on the valuation of inventory, you can Google it and look at how inventory is valued. But just to give you a summary, it's the lower of cost and net realizable value, which means that the company will be forced to take an unrealized loss on the value of the inventory if the net realizable value goes down in value. So now that we've seen what happens in the balance sheet, let's look at the balance sheet's cousin, the income statement. All right, let's see what's going on in the income statement. So again, we'll look at the three examples. Tesla as an example of an industry. So this is a company that's not in the business of investing, not in the business of creating cryptocurrency. It's only a company that speculates and sits on the sideline, buying cryptocurrency and putting it in the balance sheet. So the distinction between them and an investment firm like BlackRock and a mining firm like Riot Blockchain. So each of those three firms will have a different treatment on the income statement. Let's look at Tesla first. So for Tesla, like we said, the cryptocurrency will sit on the balance sheet as an intangible asset, right? And as an intangible asset, you only record a loss, but not a gain. And that may seem unfair. I know a lot of Tesla shareholders are pissed about this. I am one of them. Like I said in the channel a couple of times before, I am a Tesla shareholder, and I am totally upset with the move to have cryptocurrency on their balance sheet for the reasons I will get to in a minute. I have another presentation here toward the end on the concerns. Why am I concerned as a shareholder? Basically here, Tesla will record a loss, but not gains. The gains are only recorded when sold. When they sell the Bitcoin, that's when they can record an actual gain from it. But they will get to record a loss, even though without selling. So as the value goes down, if the value goes down from today, I think it's something around 48,000 per Bitcoin. If that goes down to 40,000, they will be forced to record the loss as an unrealized loss. They have to write it down, and as part of the impairment test that you have to conduct for all your intangible assets. So it's kind of an unfavorable thing that happens because of the treatment as an intangible asset, is that they can record a loss, but the gain is only recorded when the item is sold. And this is going to be different, when you look at a company like BlackRock. So for BlackRock, they are under the fair value accounting because their business model is to buy these financial instruments and speculate and trade. So this is their model, right? This is the way that they do business. So for them, it's more favorable. They get to use fair value accounting, right? Which means that they can recognize gains and losses even though they haven't sold the security, right? So if they're holding onto the security and it goes up in value, they can record an unrealized gain. Goes down in value, it's an unrealized loss, but at least they can record the actual movement in both ways. With Tesla, they're only recording one way, which is the loss, right? Only if it goes down, and the gains are only when sold, right? So this is the treatment on the income statement for Tesla and for BlackRock. Now for the income statement, like a company which is a mining firm like Riot Blockchain, like we said, this is recorded as an inventory on the balance sheet. So for the income statement, they'll have to take a write down. If, for example, the realizable value or the net realizable value goes down of this inventory, they will have to record a loss, but no gains. And the gains are only recorded when sold. Just like any inventory, you have to take a write down of the value if it goes down, but you can only record the gains when you sell it. And this is just based on the way it's recorded as inventory based on their business model. So now that you see the three models, right, these are three different types of companies, and I'm presenting this not as a comprehensive guide to all different kinds of businesses, but I want you to begin to think about it, right? This is for you to begin to read up on this issue and use this as a jumping point, right? Use this presentation as a jumping point to get educated. So as I said at the beginning of the video, this is a hot area. If you're an accountant or if you're a financial analyst, you need to begin reading up, because as an accountant, you need to be familiar with the accounting rules, because Bitcoins or cryptocurrency is not going away. It's going to become more and more widely accepted and more adopted in the balance sheet. And if you're a financial analyst, you need to be aware of all of these nuances and implications on the balance sheet and in the income statement, right? So this is not going away. This is only beginning a revolution of cryptocurrency that's going to be adopted by many more companies to come. So now that we talked about the accounting and we discussed the impacts on the balance sheet and the income statement, let's talk about the concerns. Why am I concerned as a shareholder of a company like Tesla? So we'll use Tesla as an example of the concerns around having cryptocurrency on the balance sheet. So using Tesla as an example, the first concern is that we are replacing a current asset with a long-term asset, right? So when Elon Musk announced that he's buying Bitcoin, what it meant is that he's taking cash out of the balance sheets and paying for a Bitcoin and recording a Bitcoin as an intangible asset, which is a long-term asset, right? So he's taking away a current asset and instead he's putting in a long-term asset. It might be good. It might be a good decision in the future when the value of Bitcoin skyrockets, for example, right? And he gets to record a huge gain from it, right? But in the short term, it could be damaging to the company in terms of the current ratios and the quick ratios. So these are like KPIs for the balance sheet that looks at the current asset. When these KPIs are affected, it's going to affect for example, the bond rating for the company, right? So looking at these kind of implications is important in terms of realizing the concern for Tesla. The second concern is this Tesla can only record a loss but not a gain. So the gain is only recorded was sold. Like we said, it may seem unfair, but this is the accounting rule. Tesla is recording this as an intangible asset on the balance sheet, right? And like we said, with an intangible asset, you can only take write-downs as an impairment, right, periodically. But the gain can only be recognized when you sell the asset, right? So it seems unfair. A lot of people are pissed about this in terms of shareholders, but this is the way it is, right? These are the accounting rules. The third concern that we have here is that crypto is volatile and affecting financial performance. So when now Tesla has about 10% of its cash sitting in cryptocurrency, right? What happens if Tesla will have to do an impairment test and the value, for example, of a Bitcoin went down by half, right? This can have some kind of effect to the tune of 200 million in unrealized loss from cryptocurrency in one quarter, right? Which is almost equal to the value of their profits for the quarter. So essentially, it can wipe out the entire profit of one quarter because of the volatility of cryptocurrency, right? So, crypto is volatile, and that's another concern. And then finally, when we look at cryptocurrency, there is uncertainty, right? Which could be a crash. So highly unlikely that a Bitcoin would crash, but also is possible, right? Unlike a fiat currency like the US dollar, when Tesla has its money in cash, the likelihood of the dollar crashing is much less than the likelihood of a Bitcoin crashing, right? We all know, we've seen Bitcoin in the recent years go down from 20K per coin all the way down to 3K per coin and lost about 80% of its value. So that could happen. So the uncertainty with having cryptocurrency on the balance sheet here as well. Okay, so this has been my presentation on cryptocurrency and the accounting for it. By no means it's meant to be a comprehensive guide to everything related to accounting for cryptocurrency, but it's meant to be a jumping point. I want you to be aware of it because it's going to become much more widely adopted and accepted as a means of exchange in the future. Many companies, like we said, Uber wants to accept it for Uber rides. It's going to become on the balance sheet of companies. So as an accountant or a financial analyst, you need to be aware of the dimensions in terms of accounting standards and also the impact, the strategic impact on the financial statements, balance sheet, and income statement. So I want you to be aware of it. I want you to begin researching, reading on your own this topic. The more in-demand accountant or financial analyst of the future is going to be one who's very well versed in understanding the impacts of cryptocurrency. It's going to be huge in the future, so I want you to begin reading up on it. And please go ahead and share this video with as many people as possible. I want as many accountants and financial analysts as possible to become aware of cryptocurrency and its adoption and emergence and how it's going to become a hot topic for the future. So please go ahead and share the video. I'm going to leave a link in the description below for you to download this presentation in PDF format, but it's only going to be available to my patrons on patreon.com, which is one of the ways to support this channel. And I'll see you in the next video.